Very much. I want to move on to, it won't surprise you that a lot this morning will be spent discussing the UK's exit from the EU and where we stand at the moment, and obviously no deal or preparations for potential no deal outcome are very much uppermost, I think, in people's minds. Dr. Fadiga, I wanted to start. I mean, thank you. You've given a very interesting speech, and so has the Governor in recent days. And in your speech that you gave on the 14th of February, you said that in the case of a no-deal scenario, I judge that an easing or an extended pause in monetary policy is more likely to be the appropriate policy response than a tightening. What precedents and evidence have led you to that conclusion?
First of all, can I point out that I completely agree with what the communication of the committee had been so far, which is to say interest rates can move in either direction in the case of a no-deal Brexit. I was in favour of going a little bit further and putting some probabilities on it and saying just because they can go in either direction doesn't mean that each one is equally likely. It's a judgment call, but we can't be certain about these things. It's still a probabilistic assessment. My sense is that what it's going to depend on, whether rates go down or up in a no-deal scenario, is I take it as given that there is going to be some economic disruption on the supply side, possibly severe, we don't know. And that bit doesn't drive monetary policy. Monetary policy can't prevent a supply-side disruption. What matters is whether, as a result of that disruption, you get a larger fall in business confidence, household confidence, and therefore demand, which does require monetary policies to support the economy within a framework of trading off support for the economy against the temporary overshoot in inflation above the target, which is no doubt going to be the case because we expect the exchange rate to fall, and then there is a possibility of tariffs on top of that. So these are all the things that we will be taking into consideration. And I think on balance, the risk is that the hit to confidence will be sufficiently large that we won't have to tighten. We will be thinking about either keeping policy on hold or easing. But in the end, proof will be in the pudding. We will have to see when it happens, and we will have to respond in real time. It'll be difficult, but decision-making under uncertainty is what we always do.
And obviously, households remained confident about the economic situation, and they've carried on. They continue to spend after the referendum result itself. Why do you think that a no-deal Brexit is likely to be different from the way households responded then?
I think the biggest reason why it's likely to be different is because previously we were talking in hypotheticals about expectation of possible future disruption, which some people put a lot of weight on, some people don't put a lot of weight on. Now we're talking about actual disruption happening. And so even those people who are in the camp of, well, I don't think that's very likely, if it's actually happening, they will update their views very quickly.
And I think we've talked in the committee before, and we've asked other committee members about the benefits of being more explicit, sort of more forward guidance, if you like, about likely monetary policy. I'm going to ask other committee members to comment on this more broadly in a moment. But do you think it's helpful to give businesses and households more of an idea as to what might happen? Is that a role for the committee to enable people potentially to plan in advance?
I do think it's helpful. I've set this out at length before this committee a year ago. Yeah. I'm generally in favour of saying a little bit more, but this is a committee decision, and other committee members feel different, and so we strike a balance somewhere in between. But I'm always on the side of favouring to say a little more because I do think it's helpful, and I will continue to argue that case.
So Dave and Professor Haskell, so David, let's start with you. Where are you on this about giving people guidance and potentially about what's going to happen to monetary policy in the event of a no-deal Brexit?
So on the first point, very much in favour of giving guidance, and we gave a range of guidance through last year. Back in the summer, we updated our guidance on QE. The guidance we're talking about here was the guidance we gave in November around our thinking about the future stance of policy and different Brexit outcomes. I must admit, I was comfortable with the guidance as far as we took it. We said that it policy could move in either direction depending on the Brexit outcome, and that we shouldn't. There was no automatic assumption as to which direction it would move in which outcome, and I think I would. So I'm still comfortable with that. Jan's gone a bit further, as he said. He's made a judgment on what he thinks are the balance of probabilities in a no deal, no transition outcome. For me, I would genuinely want to wait and see how the situation unfolded. In particular, I mean, Jan's talked about the interaction. I think we all assume that in no deal, no transition, there would be quite a lot of disruption. For me, I would expect demand in the economy to slow, but I would expect that disruption to also create challenges for the supply side. There's a distinction between sort of temporary challenges, how long would it take for logistical issues, say at the ports, to resolve themselves, but then you would expect over time a longer term, over a longer period, hit to productive potential. I'd want to, be looking at the situation as it unfolded. I guess, as Jan said, proof would be in the pudding of what we'd actually be looking at. But I think two other things would leave me to be a bit cautious. One is, the supply shocks of this of what this would be, no deal, no transition. Very rare, so we really haven't got much to go on. In the document we published, the bank published in the autumn, we looked at the New Zealand example after they lost Commonwealth preference. So I mean, we would be looking at a lot of different indicators to try and make sense of what was going on. I mean, a final point, one thing that I've been noticing, and the committee's drawn attention to it, is that some inflation expectations measures, particularly those derived from financial markets, have moved up a bit, whereas actually they've fallen in the US and Euro area. And indeed, had the City survey of households on Friday that suggested that also household expectations of inflation are holding up even as headline inflation comes down, and City were arguing in their piece that the inflation expectations may be more influenced by what people's Brexit expectations are rather than headline inflation. So there's a lot of different things that would go into the mix, but that's why, for me, coming back to your question, I'm not in a position to kind of put a probability on what's more likely around no deal, no Brexit, what would happen to monetary policy at this point.
Okay. Professor Haskell, where are you on all this?
Thanks, Chair. I'm very much with Sir Dave on this. I mean, my reading of Jan's really good speech was that there were two elements to it, as he mentioned. The first was, how do we think generally about the effects of Brexit? We're going to look at the effects on supply, we'll look at the effects on demand, we'll look at the effects of the exchange rate. I'm new to the committee, as you know. That's what the committee has been saying, at least since I joined, and I think it's been saying for quite a while before then. So I don't think there's any disagreement, certainly from my side, on that general framework, and I support Jan in his clear outlining of that framework in the speech. Where I'm a little bit more hesitant, and therefore I'm a little bit more with Sir Dave, is can we actually make a prediction about what we think will happen in these amazingly uncertain times? I mean, as Dave was just saying, we haven't had anything like this before. The New Zealand case, which we looked at a little bit in the inflation report, is bound up. There was an oil shock and so forth at the same time as well. It's very difficult to do that.
And I think we should go back to that, if I may. So what is our message going to be to households and businesses if a no deal, no transition scenario were to come to pass? The message will be the same as the message today, which is we will provide all the stimulus we can, subject to delivering price stability consistent with our remit. So in other words, we'll provide the support to the economy we can while keeping inflation low and stable. Now, the challenges with actually doing that are that a no deal, no transition Brexit will be inflationary. There will be tariffs. That's directly inflationary. The exchange rate is likely to depreciate, perhaps substantially, also inflationary. And as my colleagues have just described, there'll be an element of reduction of the supply capacity of the economy and how quickly demand adjusts relative to that could potentially add to those inflationary pressures in the short term. But what we have an ability to do, it's not unlimited, but we have an ability to provide some support even in those circumstances, subject to bringing inflation back sustainably to target. So we'll do what we can, but we shouldn't oversell what we can do. The real drivers of economic outcomes here will be what happens to the productive capacity of the economy, and then the reaction of businesses and households and our foreign, customers. The customers of our exporters will happen. The other thing we can do, and just to reinforce, is, and we have done, and we are confident in the position, this is stepping away from the MPC, but to the bank as a whole, is to ensure that the financial system, the core of the financial system, is ready for whatever form Brexit takes. And that is the case. We have various mechanisms to reinforce that, and we just announced one of those a moment ago. So we have the financial sector there to support the economy. We will provide the support we can, but ultimately, the remit given to us by Parliament for the right reasons is to deliver inflation at a 2% level in a timely fashion.
Okay.
Thanks.
We're going to go on. I know Charlie's going to carry on this, but I want to just turn very briefly to something completely different, Governor. This is about the retention of ethnic minority staff in the bank, because at November's meeting of the Court of Directors, you said that there was underrepresentation of ethnic minorities at the bank, quotes, on every metric, and there was a particular problem with retention. And there's an article in the Times from the 19th of February which talks about ethnic minority staff being more critical of the organisation's culture on every single measure. Inappropriate language, behaviour, failure to fit in was having an impact on career progression. BAME employees are perceived a lack of transparency in hiring, firing and promotion decisions, and were critical of the bank's narrow recruitment base. I mean, this is not good.
A couple of things. First, in terms of the article and the minutes, up until about 5 years ago, the bank published the minutes of court after a century. Now we publish them 6 weeks after the court meeting, which is right, and the reason we do it, so we're held to account, and as you were doing now. The second thing is court and the senior management of the institution are very seized with these issues. Diversity and inclusion are fundamentally part of they're one of the 4 pillars of our strategy, have been for the last several years, and we have made considerable progress on all metrics of diversity. We've talked about gender, and we can come back to that if you wish, but let's focus on BAME diversity. The proportion of bank staff over the course of the last 5 years has gone from 13% to 19% of bank staff. BAME individuals have gone from 2 to 5% of senior management. Our recruitment, particularly in the last year, our overall new hire recruitment is 39% BAME for last year. So really shifting the dial in terms of, and that's the product of a number of initiatives, from needs blind recruitment to inclusive management policies to pooled hiring mechanisms. So we're making real progress, but I think what I would take from the court minutes and the focus here is that we're not satisfied with the progress that has been made. So it's not just about numbers, it starts with numbers, but it involves the experience of the individuals, it involves the progression of those individuals, and transparently, the progression at the Bank of England of our BAME colleagues is notably different or notably worse than of other colleagues. So we've been digging deeper. Why is that the case? We think that, and this is a common issue, not just around identity diversity, if I can put it that way, but also around cognitive diversity. But some of this has had to do with the way traditional central bank structures, very hierarchical, the actual nature of decision-making and process at the institution. And that's why about 18 months ago, as part of our latest iteration of our 3-year strategic plan, is we've been focusing on changing how we work. So how we actually, some of this sounds trite, but it's incredibly
it's
important. Yeah, is, how long is a memo for a meeting? Who's in the meeting when you make a decision? How do you go around the table and actually draw out people's perspectives? How do you brief back how a meeting went and what happens next? Do we have sponsors for up-and-coming individuals? How involved is senior management in recruitment and also in affinity and identity group activities within the institution? So all of those things are changing. Ultimately, to make us more effective at doing our jobs, making better decision-making, not relying on one or two individuals to make the decisions, but to have the full weight of the institution and perspective of the institution make decisions. But our view is, and this is consistent with the discussion at court that you referenced in those minutes, and the one that you will see that will come out in 3 or 4 weeks, the last court meeting 2 weeks ago, I guess, which was the follow-up to that discussion about what's the new task force going to do on BAME development within the bank, how much we're going to widen our sponsorship program and our mentoring, how well recruitment has gone, what else we can do. And then the last thing is something that we do think has worked very well, which we put in place about 15 months ago, which is that as you start to move up to sort of mid to upper senior management, we were making a series of decisions sequentially or in isolation. And now what we're doing is we're pooling those, we're batching those together, and that has multiple advantages. And one of the advantages, speaking for Dave and myself and the other governors, is we're in the room when the decisions are made. And so it's not so much about of course it is about the specific promotion, but it's about the 3 or 4 people who don't get promoted. Why don't they? What experience do they lack? What else do they, what else do they need in the organization? What's the game plan to get them that? Or are they, in some cases they're in a position where, their future probably isn't at the bank, but dealing with that. So it needs to be across the board. The message I would ask you to take from this is, it's a top priority. We're focused on it. We've made a lot of progress, but now we're getting to the point. And I would suggest as well with gender, as we get up to that 35% of senior management level, it's the same thing, where you need to redouble the efforts and you need a broader change in how you run the organization to move further.
Sure. So 2 quick questions. Firstly, I think recruitment numbers are fine, but retention or turnover, is that's a figure that's measured as well? Yeah,
it is measured, and it is 7.5% is the turnover rate for the institution as a whole, but for BAME it is 9.2. It's 9.2 for BAME. So it's and we view that as it's materially higher, and as you referenced. Also so we do annual surveys of staff, and there's a series of indications of the extent to which people, how much they like the work environment, how productive it is, the extent to which they're mentored, managed. And I would say on most of those, and that's what's referenced in the
article.
in the minutes, which the article is just taking from the minutes, which was absolutely right. But in the minutes is that in those cases, for most of those, there is the experience is not as good, is the way I would put it. The experience actually, relative to national averages, is good, like in an absolute sense, but it's not as good for others, and that's not acceptable.
And then just the other question is, I think you've asked that an action plan should be brought to the court. When that's done, will you write to the committee, give us an update on what the actions are?
And it has been done, so has court. So, so the previous court meeting. So I will endeavour to write to you.
Yes. Thank you very much.
Yeah.
Right, moving on, Charlie.
Morning, Governor. You gave a really interesting speech earlier this month on the global outlook, and you referred to Brexit as an acid test of whether a way can be found to broaden the benefits of openness while enhancing democratic accountability.
Yeah.
Can I ask, do you think there exists, in your view, a form of Brexit that could enhance the openness of the UK economy and its competitiveness and productivity?
Fantastic.
That Charlie does.
I wouldn't. Well, let me, if I may. Thank you. First off, thank you for reading the speech. The second thing is that probably the best way to answer that question is to restrict it to areas that directly touch on the bank's responsibilities. So, with respect to financial services. And I think in terms of previous exchanges at this committee, we have talked collectively about whether or not, and I'll put it in simple terms, whether or not the UK is best served in all of those respects: productivity, competitiveness, resilience of the system, as well as service to UK customers and actually service to global customers, whether we would be best served as being a rule taker, so a form of strict equivalence, if I could put it in these terms, EU-style equivalence for financial services, where we're effectively mapping one-to-one the rules of the EU, not just as they exist today, but as they change over time. That form versus outcome-based equivalence. So, are we achieving the same standards of financial stability, market integrity, and consumer investor protection? We are of the view, and we have consistently been of the view over the last several years, that it is in the country's interests and better for our, this is a narrower point, the achievement of the bank's objectives, particularly of financial stability, if we were in a circumstance where we did have some flexibility in terms of how we achieved financial stability, so some slight differences in rules potentially that would evolve over time, all underpinned by supervisory cooperation agreements. Now, I think you want to follow up, so I'll pass it back to you, but I wouldn't mind getting into some of the details of that.
Okay, let me follow up on that. David Cameron spent ages trying to get integration of the single market with services, and frankly kept hitting a brick wall because it wasn't in the interests of our European neighbours from their own selfish interest point of view. So do you think that is, do you think that trying to sort of have a kind of commonality on services, as you set out in your speech, is an area that would bear fruit within the context of the single market type cooperation, or would it be more likely within the context of the G20 type context?
Yeah. Well, I think, so in terms of the status quo, where we are today for financial services, we do have flexibility on a number of key areas which allow us, and we do, as you well appreciate, the scale and complexity of the UK financial system is of a different order of magnitude than that found in any European EU members, other EU member state. We do have some very important flexibilities that have developed over the years. Ring fencing of retail and commercial banking, something that's come into force this year is one example. We are active users of the countercyclical capital buffer, which actually is relevant in current circumstances, potentially relevant. We have active macroprudential policy on housing. We can vary some of the capital rules, so-called Pillar 2B and Pillar 2A rules for individual banks, and which we have done. So the prudential the effective prudential standards in the UK and macroprudential standards in the UK are quite tailored to our circumstances. And full disclosure, we've testified to this effect over the years. We do think we have the necessary flexibilities under the current circumstances to achieve our objectives. Now, your question is on a go-forward basis, obviously. If we were in a circumstance where we had to take rules where we weren't at the table in order to adjust, not every rule, but on occasion the most important rules that affected the UK system, we would have concerns that we would be taking risk with financial stability in the United Kingdom.
I really appreciate that. The other thing you said in your speech, which I thought was fascinating, is you said globalization has contributed to higher imbalances of income and wealth in many countries, Among economists, the belief in free trade is totemic, but while trade makes countries better off, it doesn't raise all boats within them.
Yep.
Take the example of France. Peripheral France is frankly in rebellion with the Gilets Jaunes movement against the metropolitan elite of Paris, for whom globalisation has worked really well. Take London. You've got the regions of Britain feel completely neglected, while London is perfectly happy, and the big cities are perfectly happy because they've been the big winners from globalisation. Do you have any views on how one rebalances that so we can have a renaissance of the regions and the coastal towns like Dover and Deal that I represent, so that they can have a country, a Britain, which works for everyone, and a Britain that everyone feels they can be part of?
Yeah, well, it's a big question, and one that I think occupies you and others on this committee on a daily basis, and is a bit away from our direct responsibilities. But the first, I absolutely stand by what I said. It is basic to trade theory, and the reality of trade is that it does make freer trade makes the country better off as a whole, but there does need to be some redistribution and some reinvestment of those gains in order to bring up all individuals to, and now speaking like an economist, to make it Pareto optimal, so that everyone moves up, and that needs to be a very deliberate strategy, whatever path of openness is taken. And in financial services, one of the issues which is very top of mind for this institution, whatever form of Brexit we have, is how can we provide the framework for new financial technologies and new approaches. There's lots that can benefit the wholesale markets. Let's call it the city to simplify. But the things that we're first and foremost focused on are those that actually would benefit small, medium-sized enterprises, be they in Dover and Deal or Dulwich or Dunfermline. I'm running out of D's, but
don't forget
which one are you going to come up with?
Doncaster as well.
Darlington.
Yes. Okay.
Dorchester.
But the bigger point, if I can just re-emphasize the bigger point, which I'm trying to get across, is that these tensions. My argument in the speech is that these tensions actually are in globalization are actually starting to affect the global outlook. Trade tensions with China, other aspects that are affecting the global outlook, they are bigger, they're structural, they require a more deliberate response, and it has to balance both some element, and it's not our job to do this, but some element of redistribution or reinvestment of the gains of globalization to areas such as you referenced, as well as getting this balance between democratic accountability and standards that are high enough, whether they're for financial stability or product safety or environmental standards, so that we can have confidence that we can trade freely.
And one last question, and I should have added, I guess, not just peripheral France, but also flyover America. The whole issue is the world over. Obviously, it's quite unusual for a central banker to be talking about balancing global trade with democratic accountability and sovereignty, as well as imbalances of wealth and income. Why did you decide to stage this intervention, and what message do you hope that Parliament and government will take from it?
Well, it's interesting. It's not that unusual, I guess. I note that President Draghi's speech on Friday was entirely about these sets of issues. The purpose of the speech was first and foremost to look at the global outlook. And as I think you're aware, the global economy has been slowing. There is a question in some corners, increasingly voiced, whether this slowdown is going to become stagnation globally. It's obviously directly relevant to our purposes. I have a view, I think it's consistent broadly with the committee view, that we don't think we're going to move to a global recession, but I'm going through the risks that could tip it, and the biggest one is around, in my judgment, not necessarily committees, is around globalization. Now, in that context, I think my personal view, and I think you may share it with your line of questioning, is that the challenges around trade globally have structural drivers such as we've just discussed, and that the solution is not a textbook solution. Free trade is good, therefore we will have free trade. And it does need to balance these aspects. Then staying within remit and focus, the example, which is relevant for the bank, and if I, maybe on a personal level, relevant for my work at the Financial Stability Board, of which the bank is obviously a member, is around how financial services, how we can balance on financial services. And if I could just make one last point on that, which is the announcement yesterday with the CFTC and the FCA and the Bank of England on the new arrangements for cross-border derivatives between the US and the UK, irregardless of the form that Brexit takes, is exactly an example of outcome-based equivalence between that show that the world's arguably most sophisticated and complex markets, which is the global derivative markets, 80% of which is in our two jurisdictions, can be managed successfully with this approach.
And then one last very brief question. Also in your speech, you talked about how consumers get lower prices and new products because technology means that prices tend to fall over time for the same product. And then you talk about how workers see their wages fall. Lower prices, lower wages. What's your view of the outlook from the point of view of inflation and whether that might lead to a deflation or zero inflation type environment?
Yeah, the workers, specific workers, the workers in the most affected sectors, lower skilled workers, tradable goods sector, and there is this process of the technical term factor price equalization, but it in effect has meant in many cases low or stagnant wages, which goes to, there are many forms of reinvestment, and the most obvious form of reinvestment in that regard is training for those workers and providing them with better opportunities, and that's where you start to have trade lifting all boats. Now, when we look at it from to go to your question, monetary policy perspective, one of the judgments we've had to make, this committee, our predecessors, but tail end for ourselves, has been what has been the impact on prices of the integration of effectively China. It's more than that, but let's keep it just to China, on manufactured good prices. And what throughout the 2000s, up and through the crisis, we had disinflation, or very low to sometimes negative inflation for manufactured goods, which meant that services price inflation had to run above target in order for the balance to get at that 2%. The question is whether that's going to reverse or whether that is starting to reverse, first point. And the second point, which is hard, it's impossible to judge right now, but I think it's relevant that it is an issue on the table, which is that whether we're entering a period of deglobalization, where there will be some fragmentation or potentially significant fragmentation of the global trading system, potentially capital markets as well, which would impart an inflationary bias, all things equal, of which a no deal, no transition Brexit is an extreme example, but it's the same type of forces. And I hesitate to recommend another speech of mine, but I'm happy to send it to you. I gave one a year and a half ago in the IMF about exactly these sets of issues in a global context, and how deglobalization would reverse that. In some respects, last point, central banks had an easier ride for certainly the first decade of this millennium because of this disinflationary bias, and it may be more difficult right after I stopped being a central banker, actually. Maybe more difficult. Yeah, what a coincidence. Because of if there is this period of deglobalization, that it would impart some inflationary bias, which would make it more difficult.
Okay.
Thank you.
Okay.
Thank you. Rochelle.
Good morning. I've got some questions about uncertainty and contingencies. To begin with for Dr. Carney, and then if others could contribute, that would be great. So, Dr. Carney, at this committee hearing in November, for the November inflation report, you acknowledged that the chances of no deal were uncomfortably high rather than an unlikely tail scenario. And then at your February press conference, you said it was not the central scenario. Can you be more precise than that and just explain what you're getting at?
Yeah, so my colleagues may want to jump in, but the approach of the committee since the referendum has been to condition our forecast on an average of potential Brexit outcomes, and assume that there's a smooth transition to that average. And we're not more precise than that, but it's, you can think of the averages between a WTO scenario and something that still is Brexit, but approximating elements of EEA, if I could just put it that way. So somewhere in between is the average, and there's a smooth transition to that. So nowhere in that is a no deal, no transition, disruptive scenario. And so when you see the fan charts around our forecast, that's sort of normal economic uncertainty in any forecast. It doesn't include a disruptive scenario. Now, for the purposes of financial stability, as you know, in other testimonies, we've talked about this, we look at a disruptive no-deal scenario to help prepare the financial system for that, not a point forecast of that. The committee debated this in the run-up to the February report, and I have to say that, full disclosure, we have been for the last several forecasts expecting, well, at the next forecast we'll have a better idea what kind of deal we're going to have, and then we'll have to make the and that hasn't been the case. So we
wait with bated breath for the
we and
12
everyone else.
o'clock
Yes.
statement today. Maybe the Prime Minister will say something different.
But we debated this and took the view that it's still, when we were putting our forecast together, it was still more likely than not that some sort of agreement was going to be struck, and there would be some sort of transition to that. Obviously, the confidence bands around that that's become more uncertain. The way maybe I'll finish and hand back. The way we've dealt with higher uncertainty in this forecast, and this is an important point, is that we have maintained uncertainty's gone up, and we, instead of just assuming that after March 29th, all of a sudden everyone's certain about the future and they get on with it, we maintain that high level of uncertainty in our forecast for at least a year, and then tapered it off from there. Now, there's nothing, we obviously don't know anything specific about the prospect for negotiations, and we're not outlining particular outcomes, but it seemed reasonable to incorporate a greater degree of uncertainty in the forecast, and we have provided in the forecast a sensitivity which you may want to come on to.
Sorry, I just wanted to clarify. Does that presume, the forecast presume an extension? You discussed extension of Article 50. Is there an implicit expectation?
No. There's not. I mean, to be absolutely clear, though, whether one calls it an extension of Article 50 or a transition period or an implementation period or a banana, what we're assuming is that we don't jump from the current membership of the European Union to some new world overnight. And we certainly don't assume that we jump from the current membership to a WTO world overnight. That's the extent to which we have tried to
an extension an extension and implementation period are two different things.
They are different. They are different things.
I mean, they might still both be uncertainty, but
so there's a big difference between an extension of Article 50, even a long extension of Article 50,
well, you can still be negotiating.
And an agreement, yes, with a transition to a known end state. I guess to read into the record what I think is obvious, that, at least in my view, that long-held view, that wherever we're headed, it would serve the economy well to have a transition period to that new world. So that people knew soon where they're headed, businesses could reorganize their affairs and get ready for this new world, and government could finish its various tasks in terms
just
of
a quick
logistics.
one on that, and then I'll come on to bring in Sir David. So if it is desirable to have a transition agreement, and given we're so close to a no-deal scenario, and you've had a discussion about the prospect of further extension, for further negotiation, and so on, isn't it sensible to have some kind of extension to be able to have the transition deal rather than no deal?
I mean, I'd keep it at two things. One, just for the record, we didn't, I don't think I said this, but we didn't have a precise discussion about in fact, we didn't have a discussion about extension or not of Article 50. What we had a discussion about is what's most likely at the time we were making the forecast. Is it more likely that we're going to have no deal, no transition, or is it still more likely we will have some form of deal and some form of transition to it? And the judgment of the committee, which I absolutely agreed with, was the latter was more likely. Therefore, we kept the same conditioning assumption. But given the nature of negotiations to that point, and to some extent, given the nature of the political declaration that has been agreed, which has a fairly wide range of potential outcomes associated with it. The Prime Minister has specified one, but that it seems a reasonable possibility at the time we were making the forecast that uncertainty about the end state would persist beyond the Brexit date.
How far beyond?
Well, I almost throw it back to you collectively because it's in your hands, and I'm not trying to dodge the question because that really is the issue. Is defining. But if I could just reinforce, given everything that we have seen in terms of preparedness of businesses. And it's not because... I'll come on to that. Yeah, okay. In terms of preparedness of businesses, preparedness of the country. Yeah. And I wouldn't say this doesn't hold actually for the financial sector, which is pretty much ready. Yeah. But for the rest of the economy, on taken as a whole, is not their fault, but they're not. That it is in the interest, whatever endpoint is decided ultimately by Parliament, in agreement with the EU 27, whatever endpoint is decided, is that there is a transition to that endpoint.
But we're not. Time's running out, and we're not anywhere near there unless something changes today or in the next couple of weeks. So Ramsden, so Dave, do you want to come in?
I was just going to bring it back to the way we've approached this reflects what we're seeing in terms of the impact on the economy. We've seen this kind of intensifying uncertainty, multidimensional, about uncertainty about the end state, about whether there'll be a deal or no deal, and then a transition. Business investment in the year to Q4 last year fell 3.7%. That's incredibly unusual at a time when the economy's been growing. So out of line with UK historic experience, out of line with what's been happening in our main economic partners. And so in a sense what we have done, because we're seeing that uncertainty impacting on the economy, our assumption for the forecast is that will continue, that some of that will be locked in for at least another year. Right. And that is what's framing why we have weaker growth than we had in November in the short term. Still positive growth, but weaker growth. Yeah. And then as the uncertainty starts to subside, as the fog starts to clear, and as the world economy stabilises, then we see growth picking up. And that's all conditional on this underlying assumption that there will be a transition to a range of Brexit outcomes. But what we can do is link... Sorry,
if there isn't, you're saying 1 year with those sorts of scenarios, but if there isn't a transition, how long could we expect uncertainty to persist?
I mean, I would then play it back to, as the governor did, in a sense, it depends on
It
depends on the circumstances that we are in. But what we're seeing in real time, you know, our lived experience is how an economy deals with multi-dimensional uncertainty, and we would keep having to observe it if it continued.
Professor Haskell, do you want to quickly come back to that? Because I've got a couple more questions.
Can I just be very, very quick, if I may? I mean, just to amplify, Sir Dave's point. In a sense, what we think as a committee is hopefully rather important, but also what's possibly even more important is how businesses themselves see all of this and the probabilities of a no deal. And again, as someone relatively new to the bank, I've been very impressed by the way the bank has used its network of agents in quite an innovative way to try to get at what businesses are actually doing and the preparations that they're making.
We'll talk about a couple of questions, then we're going to come to what the business is.
I've got one more, which is, and I know others will come in on this. So on the agent survey reports, you know, half of them have said they're not ready. You've already touched on that. For no deal, no transition, and even though 3/4 of those firms have contingency plans, there are also issues about a number of them, many of them starting to stockpile. In the absence of my colleague John Mann not being here, are there enough warehouses to stockpile goods to be able to cope with a no deal, no transition scenario?
No, there aren't.
There aren't.
No, I mean that is one of the issues is shortage of warehouse space. I think what we're seeing, what we're picking up is exactly what you said. We're picking up stockpiling. Some other surveys are picking up stockpiling. You're not seeing, to be clear, it's not showing up in the hard data yet. But there's a limit. There's a limit not just in terms of warehousing capacity, but there's also a limit in terms of how much you can stockpile inputs in order to keep production going, and certainly in lean manufacturing, auto sector, aerospace, etc. It's not much of a.
So we're looking at chaos basically in that scenario.
I won't use that term. A no deal, no transition scenario would be an economic shock. It's difficult to be precise about the orders of magnitude of that. We have, as a committee, for different reasons, so it's not a formal forecast, it's only a scenario, but for the purposes of the request of the TSE, we did provide a forecast, which I would characterize as, well, we provide a forecast of a smooth transition to a WTO scenario, which does involve a period of negative growth. I would draw attention to, on page 17 of the report, you've obviously read it already, but the agent surveys of what companies expect in that scenario, which is a sharp fall in output, a sharp fall in employment, sharp fall in exports, not surprisingly, and a sharp increase in prices.
Just a quote from one press report. The risk of border gridlock caused by no-deal Brexit has led British manufacturers to ramp up their stockpiling efforts to the highest levels on record for a major advanced economy. Is this, in your view, there isn't really anything comparable, is there?
Well, I haven't seen that report. I'm slightly skeptical of that, given that the levels of inventory stocks over decades has been coming down. So depends where your history starts. We're picking it up. We think there is increased stockpiling, but for the reasons you cited in terms of warehouse space and also the overall effectiveness of the strategy. If you're truly a lean manufacturer, you're getting a few extra days, but if your perspective is that the logistical disruptions, border and other disruptions, may persist for weeks or even months, then it's cold comfort.
Okay,
thank you.
Catherine.
Thank you, Chair. As you mentioned in response to Rushnara, Sir Dave, the latest data on business investment shows it's been stagnant overall since 2016, and the recent ONS figures suggest that it's fallen every quarter of 2018 and by 3.7% annually in quarter 4, which is the largest fall that we've seen since 2010. I mean, is there anything that you have seen to indicate that data might be wrong?
One, when talking about business investment statistics, one always has to bear in mind that they do have a record of being revised. So we have, through the vintages of business investment data through last year have told a different story at different times. But so we always have to allow for the chance that the figures will be revised. However, the profile that we've ended up with business investment falling through every quarter of last year, and our expectation is that in the very short term that will continue as investment as uncertainty stays heightened. That fits for us with what we've observed from our agent surveys, from all of our, and in our reports to you, the three of us that did the reports to you, we've been out to many regions and many nations in the country, and talking to a lot of businesses, you do get this sense that despite the fact that business investment underlying conditions are supportive, the cost of capital is low, rates of return are high, certainly at the beginning of last year the world economy was doing well, that if you can wait to make strategic investment, you will, because you want to know the outcome of the Brexit negotiations. Now, probably this time last year you were thinking, well, if I was a business person, when I was talking to them, they wanted to know what the end state was going to be. Now what they want to know is it's much more short term. That's why uncertainty is intensified. They want to know, is there going to be a transition, or are we facing no deal, no transition? The option value for waiting now is very, very high. Obviously, some replacement investment will be taking place, that kind of thing. That's why business investment isn't falling further. But certainly, we think, and it's back to what I said earlier, look at what until recently it's been happening in other advanced economies. They've been taking advantage of those supportive conditions for business investment. We've been the outlier. The obvious proximate cause for that is Brexit.
Yeah. Well, I was actually going to... Okay, yeah, if you want to add something.
I mean, you asked directly about whether there's any evidence that they're wrong, and the business investment figures are wrong. We've done a little bit of digging on that, so could I just add a little bit of colour to all of that? So, as Sir Dave was saying, it is true that there are quite big revisions to business investment. It's a very difficult thing to measure. But those revisions have got much less in the last few years as the ONS has improved the way that it's measured business investment. That's one thing. And the second thing, very quickly if I may, is quite a lot of the fall in business investment is in transport equipment, and there are some slightly peculiar things going on with Monarch going out of business and therefore changes in aircraft investment. But nonetheless, as Sir Dave says, there is an underlying slowdown in the investment in plant, machinery and equipment and so on, and buildings, both relative to the period before and also relative to our competitors as well.
So I was actually going to ask, no, because you mentioned specifically, Professor Haskell, the assessments are based on, obviously a whole range of factors, but particularly speaking to different regions and regional agents for the bank. Have you seen a specific impact on particular sectors and particular regions, or is this something that's just been assessed across the board?
I haven't seen a regional breakdown of the agents' survey on this, so I'd have to check up.
Are there parts of the country that are being impacted more profoundly by the lack of confidence to invest?
It comes
others?
back to, the sectoral balance of each region. So, I went to visit the Northeast last autumn, talked to Nissan, talked to other people about what their investment intentions were, what their stock building capacities were, their warehousing or lack of it. And so for me, it's more that kind of observation. I then try and line it up with what I get from the ONS macro data. But
you'd look. Manufacturing sector, Northeast, Midlands, North Wales. Yeah. It's where you'd expect expected, and we see it. It's very. it's not just headline, but it's representative of what's happening in the auto sector.
I mean, I guess the reason I ask is because the concern is not just what the impact has been since 2016, but actually what the long-term potential impact of that will be in terms of lag from that, but also what the potential outlook for the future is for investment. And presumably there are different parts and different regions that will be affected differently as well.
Yeah. Yes. I mean, it's one illustration of this on chart 2-3, which you've probably seen, which looks at investment relative to previous recoveries, where it's down slightly. So it's about 20 percentage points below the historic range, and also below our pre-referendum forecast. It's going to be tough to make that up, but we do expect to flip it around. We do expect that, and it is part and parcel of this forecast, which again is a forecast where there is an agreement and there's a transition to that agreement, that investment growth does pick up quite smartly by the end of this year into 2020, beyond into 2021. The conditions are there, corporate balance sheets are in pretty good shape, and assuming greater clarity about market access and material market access to major trading partners.
Okay, but I mean, I was just going to come back on that in particular, because some might suggest, and I personally wouldn't, that at least if we just go ahead and have a no-deal Brexit on the 29th of March, it at least brings some certainty to all of that. And we then know what our future relationship is, and we can get on with the process of making that recovery that you've identified. I mean, what's your position on that?
I think that's completely wrong as a reasoning. So the reason why firms are holding back investment now and are nervous and want things to be clarified is because they are very worried about the risk of a no-deal, no-transition Brexit, and the disruption that'll bring along for some parts of the economy, not for all parts of the economy. If you then say to them, well, let's make the disruption happen, how could that possibly be a good thing? That just doesn't make any sense at all. And so the only way to reassure them is to say exactly what the governor has been saying in this meeting and has been saying for years is, whatever change you're going to make, tell people what the change is going to be, then give them several years to prepare for that. Don't change the framework on them overnight. So I don't accept that. I wanted to make another point about, you said that the disparities across different parts of the country is the reason why you can find some businesses who say, oh, it's going to be a disaster, and some businesses who say it's going to be fine, is because the effects are very unevenly spread, not so much across region, but across types of business. And so you can easily think of a type of business that will be very little affected. If you have a specialized UK manufacturer that buys relatively simple raw material, some basic chemicals or some steel, turns it into a very high value-added product that they sell all over the world, Brexit is not really a problem for them. If you have a company that's part of a major integrated automotive supply chain, Brexit is existential for them. And so it's no wonder that different people have very different reactions to how they think it's going to be for them. It's not because some are wrong and some are right, it's because the consequences are incredibly unevenly distributed across different businesses.
So, I mean, just coming back to the idea of ending the uncertainty, and that being a good thing in itself. There's a suggestion that there would be a deal dividend from arriving at a deal, and it was my colleague Mr. Hosey asked you, Governor, you said there's more downside in terms of a no-deal Brexit than there is further upside from this forecast in terms of investment, in terms of arriving at a deal. I mean, is that still a position that you hold? And you may be aware that the committee did agree on a cross-party basis that it's not credible to suggest that there will be a deal dividend from a deal being arrived at.
Okay, so maybe I can start on that since you're quoting me. I think when one talks about deal dividends, we have to be very careful about compared to what. Okay, so our forecast has a deal in it. So it has this recovery in investment. And so if I'm talking about by how much more could our forecast improve if there were a deal that actually was the average of the deals and there was a smooth transition, the answer is if the rest of our forecast is right, it wouldn't make any difference because we've already got that as the core assumption of our forecast. So it has to be a better deal than is assumed in our forecast, if you follow. If we're talking about a deal dividend relative to no deal, yeah, our forecast is better than no deal quite materially in our view. Now, we haven't put a precise number on that. We've given a scenario for the purposes of the TSC submission, but it's clear, orders of magnitude, that it would be better. I mean, if the question, last version of deal dividend is relative to if we had remained in the European Union. And that's relative. The best we can do with that is to look at the forecast that we had in May 2016, which assumed that we remained in the European Union. And I think you'll recall from the submission to the TSC that all the scenarios, not forecasts, but all the scenarios that we submitted, including quite close partnerships, lay below the path that we had prior to the referendum. We'll never know the answer to that because it's a counterfactual. That was a forecast, and this is relative to that forecast. But we are tracking 1.5% below that already, and potentially talking about downside risk to that.
So, I guess the point I'm making is if the idea that we are going to recover this lost investment that we've seen since 2016, it cannot be described as a deal dividend. Any uptake in investment is as a result of... It appears to be quite a loaded term, so I should be careful here. But to me, we're sitting here right now, we don't have a deal yet, or we don't have a deal that commands a majority in the House and is agreed with the EU 27. So relative to no deal, there's a deal dividend. There is that's our forecast. Our forecast, if we come back in May, if there's no deal, no transition, I guarantee you the path of GDP in our forecast will be materially lower than it is in this forecast, February forecast, which assumes that there is a deal and there is a smooth transition.
There are many ifs in this world.
And by the way, that is absolutely the view of businesses up and down this country.
There are many ifs in this world, but there's no if about coming back for the Treasury Select Committee. I'm going to move over to Colin.
Good morning, gentlemen. Your latest forecast downgrades global GDP growth, but has it settling at its potential rate. However, financial market indications of the risk of a global recession are rising. Do you think such fears are overblown or a significant risk? I'm referencing the Bank of America's recent survey.
Okay. Hugely important issue and very topical. Bottom line, our forecast, as you know, Mr. Clark, is that the global economy settles around its trend somewhere between 3.4% per annum by the end of this year, and then proceeds roughly around that for the next subsequent years. I'll give you my personal opinion, colleagues. Jump in. I think that's right. I won't go through all the arguments, but part of the speech that Mr. Elphick referenced was looking at exactly this issue. The basic view that I have is there are not major imbalances of a conventional sort in the global economy that would tip it into recession, by which I mean inflation is under control. There's relatively few signs of overheating in financial markets. There are pockets of risks, and we've talked about them in the past, including leverage lending. But again, in aggregate, I think that those imbalances at this point in a position that would cause a recession. I would make an exception for China, which is obviously a hugely important economy. There's a series of major imbalances there. Chinese authorities are working to address those, but the risks there are relatively high, and that would have a material impact on the global economy and could be what triggers stagnation. But it's not the most likely scenario. And then last point, as per the exchange with Mr. Elphick, the issues around trade are significant, and resolution of these current trade disputes, particularly between the U.S. and China, but also between the U.S. and the EU, is important. So that's big picture. Our forecast does not have a global recession. I agree with that for the reasons that I've outlined and detailed and more in the speech. And the last point I'd make is that one of the things that has happened in the last several months is that the stance of monetary policy and stance and market expectations for the stance of monetary policy of the world's major central banks has shifted quite materially. And partly as a consequence, in the last few weeks, those market-implied probabilities of global recession have started to come down again.
Gentlemen,
I'm just to reinforce what the governor's just said. I think what we've seen, market expectations of monetary policy have come down. We've seen, therefore, some recovery. For example, some narrowing of credit spreads, which we'd seen a big rise in corporate credit spreads before Christmas and in the early part of this year. They've come back a bit. Other, signs of encouragement in some equity markets. I mean, I very much associate myself with the governor in terms of, I think, the risk. We've revised down the level of global GDP quite materially in this forecast. I think by about 0.5% by the end of the forecast. That's quite a big revision between two forecasts, but we've said the risks are now balanced. China is clearly a downside risk, so I think that's why where the kind of trade tensions with the US go, and we've had some news on that since we completed the forecast.
How exposed is the UK economy in that scenario?
Well, directly, we're not that exposed, but where we are exposed is through the wider confidence impacts, I think, of trade on the world economy. Also, we're exposed through countries like Germany, which are much more exposed to China. Given we were talking earlier about industrial sectoral structure, China does a lot of trade. Germany does a lot of trade, a lot of exports with China. We've seen the German IFO index, their main business, their equivalent of our CBI index, really quite weak recently. And that's helping, it's not a help, but that's what's brought euro area growth now down to 0.2%, whereas in 2017, I think it was averaging 0.7%. So we've seen a really marked slowdown in euro area growth because particularly Germany's more exposed to China. We're exposed a bit directly, indirectly through Germany, and then to those wider confidence effects, which I think is why the environment of trade tensions is very important that we keep monitoring that.
Just before we move on, Doctor, do you want to make a contribution?
Just very briefly, I was going to make the point that a little over a year ago, financial conditions were incredibly loose and the global economy was growing very strongly. Since then, the global economy has slowed, financial conditions have tightened somewhat. So clearly the risk of a recession is higher now than it was a year ago, but I would completely associate myself with the governor, which is that from here, my central expectation is not that it keeps deteriorating and we go into a recession. From here, my expectation is that it stabilizes and actually improves a little bit, precisely because there has been an adjustment in either monetary policy or expectations of monetary policy, which should give some buffer. But I think it's reasonable to say that compared to a year ago, the risk is more elevated than it was then, but it's still not the baseline scenario.
Governor, could I just bring you back to your speech just recently, which has made you the greatest proponent of international Brexit, which delighted to see a turnaround. Can I bring you just to the point? I'd like you to expand on what you said.
Consistent with previous
poetic license, Governor. Brexit can lead to a new form of international cooperation, cross-border commerce. In light of the US-Chinese tariff conflict, can you expand on what you meant by that? What does Brexit set out that would actually improve?
Well, there's there's a couple points I was trying to make in that paragraph and the speech as a whole. One is that, as Dr. Vallega just indicated, look, we have these issues, or indicated a bit earlier, we have these issues around trade, which are one of the downside risks for the global economy. And the question is, are agreements going to be struck? Is an agreement going to be struck with the between the U.S. and China? The most recent tweets and news is more positive. The question is whether it's short-term or a more structural framework, new trading framework between those two countries. Is an agreement going to be struck between the UK and the EU 27? And on one level, the signal that comes out of the next few weeks will be very important, not just for the UK, but for the global system. Are we moving to a sharper period of de-integration, or is a form of integration possible? And if so, what form does that integration take, that new trading relationship take? So there's a short-term conjunctural, if I could use that technical term, issue with Brexit, which is highly relevant for the UK, very relevant for the EU, but also relevant for the global trading system and therefore the global economy. Then there is a medium long-term issue, which is the form that agreement takes, and in various areas, particularly in financial services, again, staying directly where we have direct interest. Can it take the form that is more outcome-based as opposed to
that was my next question.
Yeah, no, that's a core issue, and if I can make it into a more general point, which is that, and I think we reference the bank has done a lot of work on this to look around the trade imbalances of the major economies, particularly the United States, and it's our view. And it's not just an opinion; it's backed up by the analysis, but that the U.S. cannot materially reduce its trade deficit by just getting greater market access on the goods side. But in fact, if they were to reduce, if barriers to services trade that U.S. companies face were to be reduced to the same extent that barriers on goods trade had been reduced in recent decades, then they would cut their excess deficit in half. Same happens to hold for the UK as well. And services, in many respects, if you take a longer-term perspective, services trade is, Professor Haskell is one of the leading authorities on this. The economy is dematerializing, it's becoming more intangible-based, it is more services-based, and trade, if it is going to continue to grow, is going to be more around services. So, and it is not realistic, this is an opinion, it's not realistic that the whole world is going to have the same rules around service.